Hello, my name is Frayne Olson. I'm a crop economist and marketing specialist with NDSU Extension. This session, I'll focus on the corn market outlook for 2020-21 marketing year. And I'd like to begin by providing a brief overview of some of the major economic forces that are impacting the crop markets in general for both corn, soybeans, as well as wheat. The first, which has been a very positive note, has been our export pace, in particular into China. And these Chinese feed demand, and I'll talk about that in more detail in a moment, has been stronger than expected. We did expect to see with phase one agreement some increased Chinese purchases, but the feed demand in particular for corn has been much stronger than we first thought. I'm also trying to watch very closely what's happening in other countries, in particular other major trading partners like Mexico, Japan, the Philippines, and the European Union. Because of COVID-19 and some of the economic recession that's facing at a global level right now, there are some concerns about what does the demand base, the underlying demand base, look like from those different countries. One of the other things the market's watching closely is, of course, what's happening in South America. We're now in that stage of the year where South America is planting their crop, in particular for soybeans, but also for corn. And the weather conditions are going to have a huge impact on psychologically on the marketplace and what we expect for corn production and corn yields coming out of both Brazil and Argentina. Now, the current expectation is for a record large crop. Again, whether Mother Nature allows that or not, we'll have to wait to see. But that is really, those expectations are still built into the marketplace, and we have to be aware of that. One of the other things that's happening in South America is their economic conditions, the stability of their economies in both Brazil and Argentina are very weak right now. They're in the process of trying to reschedule or restructure some of their national debt, and they're going through that process right now. That's putting a lot of pressure on their currency and currency valuations. Obviously, if their currency is very low valued, it makes it easy for them to be able to sell things into the international market. But it also makes it very expensive for them to buy product out of the international market or off the global market, including fertilizer and seed and some of the machinery they need. So this is not always a plus for them, but it does make their products a little bit more cost-effective into the global market. Specifically in COVID-19 and looking more domestically, one of the things that we are watching is the economic recovery in the United States. We had a very rapid recession. The 2 months of negative growth in the United States. We've seen a partial recovery right now. The growth rates are slowing considerably as we move forward in time. In the expectation, at least for the next 12, possibly 18 months, is that the economy will continue to expand, but at a much slower rate than what we've seen the last couple of months. And a lot of that is because of COVID-19 and the economic slowdown. The expectation is we really won't kick back into a major recovery phase until we have vaccines that are readily available to the general public. Now, we don't know exactly when that's going to happen. I think the current mentality, the current expectation, the outlook is sometime mid-summer of 2021 before we have, again, widespread vaccinations available. Now, up until then, until we see more of an economic growth, the US dollar, the value of the US dollar is expected to remain relatively stable, kind of at these lower levels that we see today. Now, they're not low by historical standards, but they're not nearly as high as what we've seen the last couple of years. So this is helping and helping our US exports, but it's not to the point where it's really hindering our ability to import either. One other thing I want you to just be cautious of and be aware of is that we may see some company-specific slowdowns or problems within our grain supply chain. Now, I'm not expecting any broad-scale or wide-sweeping kinds of economic problems or issues like we saw in the meatpacking industry because of COVID-19, but I have heard and talked to several general managers and CEOs that are concerned about employee absenteeism and their ability to have healthy workers, whether they are sick themselves or those workers have been exposed to somebody with COVID-19 and have to go into quarantine. Just the availability of a workforce and uncertainty about who can show up for different shifts might cause some temporary disruptions at the local level, whether it be a local elevator or a processor. Just be aware of that and be conscious of it as you move forward. Turning back internationally again on the global stage, specifically talking about US and China trade relations, please understand that the political and economic tensions between the US and China are expected to continue. Just because we've now had the election and that's over with, that doesn't mean that the trade tensions and these economic and issues have gone away. We're still not sure exactly what this all means for agricultural trade policy specifically, but it's not expected to change anytime quickly. There might be some shifts and adjustments, but anytime you talk about trade policy, it can take considerable amount of time to work through any kind of changes or revisions. One of the other things I'm watching is what's happening in Europe, in particular with Brexit, where the British economies are now trying to separate themselves from the rest of the European Union. They're in the kind of the very end of their negotiations right now, and how the structure of that agreement will have, in my opinion, a pretty important role to play in not only the strength and rebuilding of the economy in Britain, but also the impact it might have on the European Union. And now specifically, the British and the United States have been negotiating on a trade agreement. That negotiations haven't been very quick. They haven't gotten very far on it, but I suspect that will increase the urgency, and the pace will increase relatively soon after the Brexit agreement, if they can get to one, has been signed. The odds of having a US-EU kind of trade agreement or renegotiating some of those terms is very unlikely, mainly especially for agriculture, mainly because of their common agricultural policy. So I am watching that, and my biggest, I guess, issue is the euro is often considered to be that reserve currency to the US dollar in international trade. And if the European economy, the European Union, is not doing very well, that currency may or may not be very competitive against the US dollar. I want to jump now specifically into the corn supply and demand conditions, give you an update on what's happening there. This information is from the November World Agricultural Supply and Demand Estimates. This is the one that was just released a few days before this recording. I don't have time to go through all of the information, but I will point out to some of the key numbers that you need to be watching and paying attention to. I'm going to focus on the numbers on the far right-hand side, which is the ones highlighted in blue. Those are the most recent forecasts for the current marketing year. Again, so it starts on September 1 and runs to the end of August. So this is the crop that we just are in the process of finishing harvesting now, and we'll be looking at trying to sell and merchandise over the rest of the time period. So the two important numbers, I guess, that took kind of the markets by surprise in the November report was, first, the updated forecast for national average corn yield. Now, the trade was expecting a slight cut or slight reduction in the forecasted corn yield, but the reduction was much larger than we had expected. Actually, it was about a 2.6 bushel per acre cut from the October report. Now, to put that in perspective, before the report came out, the trade was kind of expecting a number anywhere from 176 bushels per acre to about 179.2 bushels per acre as a national average yield. The actual number that USDA came out with was 175.8. So it was actually technically just below the lowest trade estimate. And again, that was the surprise to the market. We're not going to have as many bushels in the supply chain as we first expected. Now, the crop is not short by any means. It's still a very large corn crop. It's just not as large as what we first thought it would be. The other major change that was made was an update to the forecast for total U.S. corn exports. The export forecast was actually increased by 325 million bushels, primarily due to the strong Chinese buying, and I'll talk about that in more detail in just a moment. So again, two major revisions going on. We saw a slight reduction in the total bushels produced. We see a slight increase in the total consumption. And all of a sudden, the bottom line, or that forecast for our ending stocks, the amount of grain we're going to have left in the bin just before harvest of next year, suddenly got cut pretty substantially. Now, once again, the trade was expecting some slightly lower numbers than what we saw in October, but not the dramatic cut that we actually received. So the trade expectation before the report was anywhere from 1.85 to 2.2 billion bushels of corn in reserve. The number that USDA actually came out with was, again, well below what the trade was expecting at 1.7 billion bushels. So again, this is really starting now to tighten up our supply chain. We still have adequate supplies. Don't misunderstand. We still have adequate supplies, but those supplies are a little bit lower than we had first expected. Very soon now, as we move past this production issue and all of the questions revolve around yields, we're going to very quickly shift into focusing on consumption, or how quickly are we using up the available stocks. So I wanted to provide a really quick overview of where we're sitting and some historical background. The blue line on top is the total amount of corn that goes into the livestock sector. It's called feed and residual. So think of this as the amount of feed that's consumed by livestock in the United States. So that's the blue line. The red line is ethanol production. So again, our ethanol consumption. So these are the two major users of corn in the United States. The little dots on the far right-hand edge of this graphic represent the current USDA forecasts. The black line towards the bottom is exports, the amount of corn that we export. The green line is kind of everything else. It's all of the other industrial use as well as seed use. So a couple of things to note before I move on. First, we've seen the last 2 years a pretty dramatic cut in the amount of corn going into the ethanol industry, and there's several reasons for that. One of the major reasons, of course, is because of the economic shutdown, with now a recovery, but our miles driven, the amount of fuel that we're consuming within the United States, has dropped pretty significantly. Now, USDA is forecasting a rebound or a slight recovery in the amount of corn going into the ethanol sector, but that recovery is not going to be nearly as strong as what we had seen pre-COVID. Now, fortunately, because of this cutback in ethanol, we've seen a pretty dramatic increase in the amount of exports. And again, USDA right now is currently forecasting record export levels for U.S. corn. So the reduction we've seen in ethanol consumption has been more than compensated for, more than offset by an increase in expectations for exports. So again, the export market is now taking a very dominant role in people's psychology as we move forward in time. So to look specifically at some numbers, we're very fortunate in the corn industry to have weekly updates on ethanol production. The Energy Information Administration, which is part of Department of Energy, keeps track of weekly ethanol production, and because of that, we can back calculate in what we expect to see for corn usage into the ethanol sector. This is a graphic that goes back into September of 2013. These are weekly numbers. You can see them bouncing around seasonally. We tend to have a seasonal pattern in ethanol production. Notice the very dramatic drop that we had in ethanol production during the economic shutdown, during that time period where everybody had the stay-at-home orders and the companies were asked to shut down for a time period. We have seen a fairly substantial rebound or recovery in the amount of ethanol that's being produced, but it now looks like it's kind of stabilizing, but it's stabilizing at a lower level than we saw pre-COVID. The current expectation in the energy industry is that the miles driven and the amount of fuel consumed in the United States won't really recover for quite some time. Again, we're looking at probably a 12 to 18-month time horizon. So it looks as though the ethanol consumption will be a bit lower than what we've seen, and it'll take quite some time to rebuild to pre-COVID levels. When we shift to exports, this is a graphic of accumulated exports. So these would be actually bushels that have been loaded onto a vessel and are now leaving the country. Again, every time that we make an export, have an export delivery, those bushels are added to the pile. What we'd like to see is these pile of accumulated exports grow as quickly as possible. If we look at the numbers through the most recent information I had of the recording, which is the end of October, we're kind of in the middle of the pace for early on in this export season. But a lot of the attention is not necessarily on the amount of grain that's already left, it's on export commitments. So an export commitments would include not only grain that has been purchased and in the process of being delivered, but also the grain that's been contracted for delivery in the future. So these are bushels that are actually been contracted for and spoken for from a legal standpoint. And so again, these are the numbers that the futures market watches very closely to try and get a read on how quickly we're chewing through our domestic reserves. Our two number one customers for U.S. corn historically have been Mexico and Japan. And again, Mexico, you can see the nice growth rate we've seen over time. Mexico is traditionally our number one customer for U.S. corn. Again, coming back to what's the impacts of COVID and economic recession, Mexico has been hit very hard by COVID. They've seen very high death rates. Their economy is struggling right now. So far, it doesn't look like export pace of corn or wheat has really been hampered by that. but it is something that has me a little bit concerned and we'll be watching as we move forward. The big surprise in the corn market has actually been China. And again, this will be a reoccurring theme. So the column on the far right-hand side is the export commitments through the end of October. And now historically, China has not been a major buyer of U.S. corn. Periodically, they do come in and buy larger quantities. Our previous record corn purchases by China was in 2012-13, and that was at about 5.2 million metric ton. Well, if we look at what the accumulated export commitments are to date, they're at about 10.7 million metric ton, all double the previous record. So again, this has really been the surprise for the corn market. Fortunately, again, because of the cutback in ethanol, these exports now have backfilled that usage. And again, that's going to put some more enthusiasm back into the corn market on what the future might bring for us. So the marketplace is focused very, very closely on export sales, not only to China, but also to Japan and Mexico, because they're such historical large customers of ours. I guess I'd like to give my assessment, my viewpoint of why China has been buying so much U.S. corn. And the real reason, in my view, is there's huge demand from a livestock feed standpoint. China is now starting to rebuild their pork herd. Their poultry, is for both meat as well as eggs, as well as their dairy and aquaculture industry, have been expanding and expanding fairly rapidly. But now with the resurgence and rebuilding of the pork herd, that underlying feed demand is very strong. And there's some signals that we're getting in the marketplace that this is actually happening. A big one is that the Chinese did have a pretty good corn crop. It was good, but wasn't fantastic. Now recognize China is the second largest corn producer in the world, right behind the US, but they use almost all of their corn domestically. And so again, they had an okay year, but not a fantastic year. So when we look at what's happening internally in China, the government continues to auction off their corn reserves. So they have relatively large government-owned reserves. They've been selling those off at auction. The auctions have been going very well. The volumes that have been offered up have all been purchased. Auction prices have been relatively strong, which all signals that there is this strong demand internally for corn within China. The other thing that's happening is if you watch what the Chinese companies are doing, they're also not only importing corn, but they're also importing larger volumes of other feedstuffs like barley or grain sorghum. And again, this is a signal now, another indication that there's this building demand base, that there's an increase in the consumption for feed and feed products internally. We're also starting to hear more and more stories or more reports that low-quality wheat and or low-quality rice are being used as a feed source as well. Again, another indication that as corn prices going up, domestic livestock producers are looking for some alternative feeds to feed their livestock and reduce their feed bills. Again, just another signal that things are happening internally within China. We're also seeing both the private companies in China as well as the government-owned grain buyers like COFCO coming in and buying and rebuilding some of their inventories at the firm level, at the individual company level. So not only the Chinese government reserves are starting to be brought down, but the individual company reserves are starting to build. And there's a couple of main reasons for that. One of them is this continuing trade tensions between the United States and China, and some concerns about what if that rebuilds to levels, the tariff levels that we saw previously, and there was some supply disruptions. They want to have something in reserve. The other thing is, primarily in soybeans, but also in corn, there's concerns about the production levels coming out of Brazil and Argentina, because there's some weather issues now starting to develop in both southern Brazil as well as Argentina. I get a lot of questions about the Phase 1 agreement and what the impact Phase 1 is having. In my view, the big kind of driving force or big benefit created by the Phase 1 agreement has been a lot of those barriers, those things that prevented U.S. products from entering the Chinese market now have been either reduced or removed. And so the flow of product from the U.S. into China is a lot more smoother than it used to be. A lot of attention has been paid to the promise that China made to purchase additional U.S. agricultural products. They are doing that. They're tracking it through dollar volumes, not necessarily physical quantities. In my view, I don't think we're going to quite reach those targets originally laid out, especially for 2020 calendar year, but they will be above the levels that we saw in 2017. So just to try and wrap up this corn discussion, I wanted to close with, again, kind of a synopsis or a big overview of what's going on in the corn markets. The green line on this graphic represents the total production of corn in the United States. The red line represents total use, including exports. I want to focus on the blue bars on the bottom. That's the stocks to use ratio. So if we take our ending stocks divided by our total use, it's this percentage that we get. So think about it as what percentage of our total needs will be in reserve in case there's a problem next year. And of course, as those reserves are drawn down, average prices tend to increase, as well as prices become more volatile because there's some more uncertainty about what the proper price level is. As you can see from the graphic, we had some relatively high ending stocks for corn the last several years. We're now slowly starting to take those levels down. The red bar on the far right-hand side represents the current November number. It's not as low as what we've seen back here in the early 20-teens, but obviously considerably lower than what we've seen the last couple of years. So again, the expectation is that we'll have a slightly higher average corn levels, but we'll also price levels, but we'll also have a bit more price volatility. So with that, I'd like to thank you for listening, and hopefully you found this valuable, and we'll be able to follow up in person, or at least within a Zoom meeting or something, and we can answer some questions later on. So thank you for joining me.